All right, everyone. Thank you for joining us. We're about to get started. This webinar and the opinions provided within are provided for general informational purposes only and do not constitute legal or professional advice. No user should act on the basis of any material contained in the webinar without obtaining proper legal or other professional advice specific to their situation. Please note that this webinar will be recorded for later use and made available for viewing on YouTube, Facebook, and Energize Colorado. Now, questions can be asked, but please do enter them in the Q&A window. Chat has been disabled. And please also note that the KPMG checklist is located on the Energize Colorado website, where you'll find Get Help, videos, and webinars, as well as the download link to get to the KPMG nonprofit checklist.
Thank you, Justin, for that introduction. This is Rennie Fagan. I'm the CEO of the Colorado Nonprofit Association. I'd like to thank KPMG for providing their expertise today to everyone who is participating in this webinar and also those who will view it later. This effort is brought to you by Energize Colorado. Energize Colorado is a part of the started out as a part of the Governor's Economic Stabilization and Growth Council as a way to prepare Coloradans, businesses, and nonprofits for the world in which we now live, the unprecedented world in which we now live. During that process, Energize Colorado became its own nonprofit organization and is providing many resources that are available to businesses and nonprofits and gig workers across Colorado. So this is one of a web series that is directed towards nonprofits, but there are other webinars available that would also be of interest to nonprofits that cover many topics that would be applicable. And also the website itself has many resources at energizecolorado.com. Again, this is a special webinar that is directed at the kinds of financial issues that nonprofits are now facing based on your businesses now affected by COVID and what you project for the future. And also, we'll talk about some of the provisions of the Federal CARES Act and other government programs that may be applicable to nonprofits. I, again, want to really thank the KPMG team who is giving their time to this effort, not only on this particular webinar, but other webinars, lending their expertise and their experience as they are advising nonprofits all over the country and have a lot to share with us. So as Justin, our moderator, said at the outset, if you have a question, please type it into the Q&A box. Before we get started, I see that there is one question in the Q&A, which I really appreciate, and it's about how a nonprofit may receive pro bono CPA assistance or assistance from a CPA. And right now, I'd say my best recommendation on that is to email me. My email is rfagan, and I'll type this into the Q&A too, rfagan, F-A-G-A-N, at coloradononprofits.org. So we've got a lot to cover today, and I wanted to start by introducing Dave Gagon, who is the internet industry leader for higher education and nonprofit practice at KPMG, for an introduction, and he'll introduce the what's ahead in the rest of the KPMG team. So Dave, take it away.
Rennie, thank you very much, and good afternoon, everyone. Thank you for having us today. Really appreciate the opportunity to present some information to you and hopefully to exchange information with you as well through questions and answers later in the program. I did want to say that we have a great group of presenters, and we'll get to that in a moment. Our presentation is really focused around, again, the impacts of COVID-19 and several considerations that not-for-profit organizations may want to keep in mind as they try to navigate through this crisis. And I know that the industry has been hit pretty hard. We work with nonprofits of all shapes and sizes, and it would probably be wrong to say that they're all being affected equally by this crisis. Some are better positioned than others, but nobody is immune from the crisis. I can tell you that much. We are going to focus on lots of things that are really specific to finance, particularly. For example, we're going to talk about cash flow budgeting and planning and the importance of that. We'll talk about some disaster recovery planning and ways to mitigate issues that you are encountering, including through potentially the CARES Act. Before we get into those things, I just wanted to say my background is in audit. And as an auditor, I can appreciate that every organization is going to make many decisions, and probably already has made many decisions over the last several weeks. We'll continue to make decisions over the next several months as we try to navigate and then emerge from the crisis. And I can't overemphasize the importance of your interaction with your governance, your board members, and their involvement. It's really key to any successful plan. And in addition to that, I think maintaining documentation about all the key decisions that you're making is really critical, especially as time goes on. People tend to remember what's most recent. And with this crisis, a week can feel like a year. So it's really important, even if you take informal notes, to document as much as you can about your thought process, why you made certain decisions, and really maintain a good comprehensive trail of documents so that there's a trail later for auditing or inspection. You don't want to be second guessed about anything you do here. Some of the programs that are out there and available to you are valuable, beneficial, but they can be complex, and they're not without some challenges in that respect. So my advice would be just remember you have to think about compliance even in a time like this, and it's really challenging. With that, I'm going to turn it over to our first speaker, my colleague and partner, Jeff Plant, who's going to start off the conversation. And we will try to then open it up for some questions once our speakers have a few words to say. Jeff?
Thanks, Dave. Can you hear me okay?
Yes, thank you.
Okay, good. Just switching between technology platforms all day. You want to make sure you're on the right one here and the mics are working. So, hi, my name is Jeff Plant, partner with KPMG in our advisory practice, but like Dave, I started in audit and I am a CPA, and I'm going to be co-presenting with Julie Barrientos. A little of my background, not only do I serve nonprofits, but I currently serve on 2 nonprofit boards, one a regional food bank and one an entity that helps families that are struggling with children with, really bad diseases, trying to get through a low point while their kids are in the hospital. And then for 7 years, I was on the board of the Ronald McDonald House, including chairman. And before that, actually treasurer of a national sports organization, and kept them afloat during 2008, 2009. So I've been in your shoes, and I understand what you're dealing with. And recently, a month ago or so, we had a national/international nonprofit, a very large one, call us and say, "Can you help us? We don't really know what's going to happen with our revenue. I mean, expenses, you can kind of, if you keep everything the way you're doing, you know what your expenses are, but revenue, you're so dependent on outside sources and donors. It became, a real challenge." And before I jump into it, I'm going to let Julie introduce herself, because we're going to co-present here a little. And I want you to hear from her before we jump in.
Okay, great. Thanks, Jeff. Can you hear me okay?
Yep.
Excellent. Hi, everyone. My name's Julie Barrientos. I'm a director in our financial transformation practice. I, similar to Jeff and David, started out in the audit practice. I spent about 18 years in KPMG, state and local government audit practice, where I also had a lot of not-for-profit clients. I did all not-for-profit, state and local, state and higher ed. So I've seen the gamut over the 18 years, and have never seen anything like this before. So I commend all of the not-for-profits out there and in navigating through this difficult time, and do our best to try to help you through it as well. So turn it over back to you, Jeff.
All right, thank you. So, we put some, obviously, we only put one slide up because we didn't want to, these are talking points more than, we didn't want to get into draining slides, and we wanted this to be a little interactive so you don't feel like you have to, if there's a question that comes in or any, just stop me at the right time. But, what we're
You
seeing.
can go to the next slide, Justin. Well, there we go. Thanks.
There we go. So what we're seeing with our clients as they call us or ask us for some advice is, no one really has dealt with what we're dealing with before, right? And yes, we've had financial downturns and things like that, but we were always able to go to the office. We were always able to have that more human interaction with our clients or donors, and obviously everything went up in the air back in early to mid-March. So the biggest thing our clients were saying to us and the nonprofits we're on is, how do we keep the cash flow? Depending on the size of your nonprofit and how much you have in the bank, you may not have a lot of cash in the bank to keep your operations going for a long time, right? Some, if you're lucky, you have a year or so, cash and investment. Some, that are really tight may have a month. So one of the things, we got asked is, okay, how do I start this? So what we did is, you come up with 3 scenarios. We always say, what's the best case, the mid case and the worst case, and start with, what is it you need to keep the lights on, right? What is it you need to do to keep your core mission going? And sometimes in a nonprofit, we have our core mission, and sometimes we get side things here and there that we add to the core mission over time. So one of the things, the first thing we said is, start with, what's your core mission? What is it you actually have to do, and what's it cost to do that? So let's understand what that line is. How many people do you actually need to run that, space if you have that? What are you obligated to? Do you have leases that you can't get out of versus things that may be month to month? So we started with, what is it actually you absolutely have to have? And by that, you can kind of start saying, okay, what we call levers do you have to pull in each of these scenarios? So then we started with, okay, let's say we use different models and we work with the client, but okay, let's say our revenue goes down 15%. Where's that revenue? Where are we most likely to lose revenue? We started looking at all the funding streams. So, depending on the type of nonprofit you are, but, if you're dealing with galas or nonprofits or things where it's human interaction, people spend money, and now you can't have those, how are you going to shift? And even if you shift to something online or virtual, how's that going to affect your revenues? So we really start saying, okay, first, let's look at what your revenues are going to be in each of those scenarios. The other thing we looked at, and it's very important, is what are the things you have on your balance sheet, or you have, say, that you can tap into that you may not have. For example, pledges owed. If you have some wealthy donors that owe you money, that may be over a 5-year pledge and you're in year 2, could you pull that forward? We looked at if you had restricted funds, could you use the cash? And one of and I'll let Julie talk about this in a minute, but accounting, accrual versus cash was very important, and one of the things we need to talk about. So if you have cash on hand, even if it's restricted, how can you access that cash as long as at the right time it's back there to get you through a loan? Those are some of the questions we started posing to the client, and depending how big or small you are, what's your physical asset presence? Do you have leases? The one client we worked with, for example, was they had 90 offices around the country. 3 leases were coming up right away. You don't enter into that. So anything that was cash going out the door and things like that. Julie, you want to jump in here a little on some of the accounting versus accrual versus cash and some of the other things we looked at in that? space?
Sure. I mean, that was really the main thing that they looked at. They backed all of their P&Ls back to be on the full cash basis, and then really went through an evaluation to see, what they could sort of either extend out or not, or get rid of to not pay without having penalties. Because if you think through the process of a cash versus a full accrual, getting rid of expenses, you might have some impacts in that, like if for example, if you are um, laying off employees, you have severance packages that you're going to have to pay no matter what. So you have to factor that into the cash part of your estimates. And I think, the one thing that they did, or that we did during this whole sort of cash flow evaluation, was, I think what was really, what hit home to them is that they really wanted to maintain sort of the same level of program percentage expenses that they have done in the past. They didn't want to lose that functional program and fundraising type of spend. They wanted to maintain that so that they could continue to fundraise for the core program missions that they wanted. So they literally took that percentage and then applied it back using the revenue estimates after they went through all of the the fundraising and the events that they could either A, had to cancel, or B, had to modify to make virtual. They made a lot of their up and coming fundraising events virtual. They did virtual runs and walks and those types of things. And they maintained that and we helped them come up with those three sort of low, mid, high that Jeff referred to estimates. And as a part of it too, when you're going through this, you might want to think about, I really truly think that at the end of the day, when this is all, if we ever get back to the same set of normal, which I don't think we will, that I think that the whole service delivery model will change. And so, one of the things that we suggested they do is to take a look at the multiple locations. Is there duplicity going on in the different locations, either from an accounting or for some, whatever else that they're doing? Are there some administrative type things that they can consolidate and make more efficient for the longer term? And clearly you're not going to get a quick, pick up in cash at that point, but it's thinking, kind of thinking the short and the long term from a liquidity standpoint, not really knowing what the environment's going to be in a month, 2 months, a year from now. Again, I don't think it will ever go back to normal completely, but just thinking through some of the things that you could change that would make the cash, the cash flow better, and be able to still maintain that program ratio that most not-for-profits want to maintain. And the other point that I wanted to make before I turn it back to Jeff is thinking through, the functional expense allocations. Everybody does their program admin, fundraising, functional expense, but which is great as long as you're keeping those percentages updated. So you want to make sure that the data you're using isn't old, that you've, so maybe take this time to do a refresher on how you're allocating those expenses to make sure that they're accurate, because that does sort of filter through the whole process of evaluating how your administrative expenses link into keeping that functional, or the program part of your business going. I'm trying to think if there's anything else that I wanted to. Jeff mentioned, the issue, thinking about internal borrowing. You have to weigh whether you want to have sort of from cash liquidity standpoint, do you want to go into a letter of credit, or is there some internal borrowing that you can do? Clearly, going back to Dave's comments at the beginning, you make sure you're in compliance, that you're not violating any donor restrictions, but consider that, get your legal department involved with, what you can and cannot do from that aspect. And don't forget that if you have, your investment returns are also changing. I'm sure nobody's forgetting that, because I know I'm not, and there's a reason I'm not looking at my retirement statements. But clearly you have to factor that into your revenue estimates. Don't forget that you're going to have, everybody's going to have a hit on that for at least a year, if not longer, before it really recovers. And then consider working from home. Could that be a long-term solution? I mean, I think we all thought that the work from home might be challenging more, at least I thought it would be more challenging than what it really is. And I think, maybe we don't all need to have an office to do the work that we need to do to keep the business going. And certainly I think that might be attractive to some employees as well. Maybe they don't want to go into the office, so it's a win-win in both situations. But it's just a matter of, factoring in all of those types of considerations as you plan not only for the short-term issues, but also for the long-term issues. So I'm going to turn it back to you, Jeff.
Yeah. And one of the things, thank you, Julie, I was thinking of is obviously there's a lot of different type of nonprofits in the state. Associations are a major one, right? Where you have a lot of members. Hopefully they're still paying their dues. Hopefully you're not as affected as much, but you may see some people starting to say, hey, I'm out of work right now, I can't pay my dues for a while. Conversely, you might get some people where if you can accelerate their dues and maybe say instead of it lasts for a year, it lasts for 3 months. But the one thing we would say is when you start doing forecasting, and I'm sure many of you are well into this or have been doing some of this, go out a year or more on your forecasts, get through at least a full cycle of all the different type of business events you have as far as, how you do your fundraising. So you want to get through a full cycle. And then it's a matter of literally taking a hard look at, like I said, there's the things that you absolutely have to do. Then there's the things you like to do. So for example, switching communications, like I know a lot of nonprofits still feel like newsletters, sometimes in magazines, things like that, communications need to be hard copy because it's kind of what members have expected for their dues or for their donations. Just switching to, hey, we're going to go online, saving all that printing, all that mailing. Sometimes changing the frequency, if it's every month, going to every other month or quarterly, things like that. We've seen nonprofits were associated with doing that. We were talking about education in schools today. There's a lot of talk about, if you're a nonprofit school and all of a sudden people saying, hey, we can do this online. What does that change if people are, if you're a private school and you're used to getting a certain amount of tuition and now you're going online, does that change the experience for the student and should the tuition change? So there's a lot of those. When you look at that, you do still have to think about your member or your stakeholder base, donor base, depending on who you serve, and how that's going to impact them. And obviously, that's where your boards will come through to give you that perspective. Just a couple other things. I was just on a call this afternoon, and the one thing, unlike the last financial crisis, the banks are very strong right now. Banks have money. Obviously, interest rates are low. Not that I'm saying go out and borrow, but there's flexibility out there. And I think also I'm seeing locally where I live, the banks are trying to help out and be good partners. So I'm sure many of you have talked to your banks or lenders, and depending if it's a loan or if it's how they're doing community giving, depending on what your mission is. And I'm just looking at, again, this is going to change how you do things in the future, but I would say looking at what you have and what you're accustomed to now and what you can deal without in the future, I think is going to change. So as you start looking at the future, when the leases come by, do you own your property or not? Hard decisions on what you can do to be more nimble. So in fact, some of the more of the money may go to mission over time than what we're used to. I know we're all used to some of those ratios, especially when it's a mission-based charity. I think I want to take and see if we have any questions or dialogue that people will have before we move on. We've talked for a little while here.
Yeah, Jeff, this is Brett. I don't know, Justin can jump in if people can ask verbal questions, but please do, if you have a situation you're dealing with, we're happy to
that's what we're here for.
Get any dialogue going. Justin, can participants or attendees raise their hand or just through the Q&A?
Just through the Q&A,
Okay.
they can raise their hand. I believe there's the option to do so. I don't see anybody has.
Okay.
So if somebody does, I can certainly turn on their microphone. But again, for people, if you do have questions, please type them into the Q&A window. We have disabled the chat window, but you can certainly type your questions into the Q&A window.
The other thing I'd offer is that if it's not a question, or maybe just share with us the areas that you're most challenged with, perhaps that will
You can point to
trigger
that.
something, Jeff, that we've seen or could open up for a discussion. Interested in what's happening here in Colorado.
You know, one of the other things I've seen some of the nonprofits starting to think about is how can they consolidate resources together? So putting some of their, you know, maybe some of their back office, like accounting, share an accountant, share HR, some of that stuff. I know in some places it's prevalent, but we are seeing other ways, look, you know, to help each other. You know, you're all, you know, trying to help your community in general. So as I was just going through some of our bullets, that's another thing we're seeing more of. Here's a question. Let's see. I'm looking, okay, I'll read the question. I'm looking to start a nonprofit right now. I want to use the 1023 EZ form since I don't have any projected revenue for the next 3 years. Are there any negative implications if I happen to exceed the 50K limit in any of the first 3 years? Luckily, we have someone from tax on.
Yeah, that sounds like a
team.
Mark question. Mark, are you still with us?
I am with us. The 1023 that I want to make sure that I understand the question. The question is around is there an implication if they go above the projected amount
Yes.
Yes.
of gross receipts? I think the information is really based on when you're filing it. So if you're projecting those gross receipts, then you would be you only have the best information that you have at the time. If you can attest to being under that, I think filing the application at that point under the easy works.
So if they go over, there's not a, you know, they just deal with it at the time, but it's not going to be catastrophic that they shouldn't try to do it now, right?
Correct. Not to their exemption application, and they're testing to what their operations are at the time.
Mm-hmm.
And you put your financial projections in there. If that happens to change in the future, that wouldn't affect their ability to take and use the 1023 EZ if that's what they're attesting to at the time.
Okay. All right. I think Ryan got his question answered. All right. Any other
Mark,
questions?
why don't we come back at the end, Jeff? Maybe Mark can start moving to the CARES Act. And Justin, if you would fast forward the slides, and then we can come back at the end and debrief. Thanks.
Well, my name is Mark Shelton, and thank you for having me here today. I'm a managing director, serve clients, provide tax and advisory services to clients. I'm located here in Denver. A little bit of my background: I spent almost a decade in industry at a large nonprofit health system, and prior to that, I was in public accounting. I'm a CPA, and got my start in audit like the rest of the team. I've been getting a lot of calls the last couple of months related to CARES Act questions from clients, and you know it's interesting. Some of the questions, some of the clients are telling me, you know, we're okay. We think you know, we're in pretty good shape right now. Revenues really haven't dropped off. We've heard a lot about these provisions. You know, do I really need to be concerned with that? we're thinking that, you know, maybe there's some drop off in some contracts and some revenue, but we really don't see that at this point. Can you explain to me what might be relevant? Other clients are saying to me, hey, we are really hurting right now. We had to close the doors. We had to send people home. A government order, you know, said we had to shut things down. We're operating the best that we can. Our contributions are down. Cash flow is down, and right now is the biggest time for us in terms of need to go out and do the good things that you know, that our mission is compelling us to do. And so there's there's the CARES Act, and tell me how these things will apply. What's available to me? How can I get cash? How can I get liquidity? Give me all the answers. There's so many different. I'm being hit in so many different ways by all these provisions. There's just so much. How do I get started? And what do I need to do? And how do I implement these things that are available? Help me sort through that. And the conversations that I've been having with clients, I think you can move on to, no, you are on that slide, are really outlined. This kind of sums up what I've been talking about with clients. Things that are available through the CARES Act that can get clients cash and liquidity because they're concerned. How do we pay employees? How do we pay rent? And how do we do? How do we continue these operations right now? And I'm not going to get too technical in these, and it's kind of hard not to, but I'll try to keep it as high level as possible. But the point of going through these things is really to give you as a listener some takeaways, some discussion points that you can have and then take with your advisor and really get into the detail on how these things might work. But you might hear it on the call today and say, I didn't know that was applicable to me. Can we look at this? And this seems like a good opportunity for us. The provisions that are coming out, I'll just start with there's credits, there's tax credits, and then there are loan facilities, and then there's some other tax provisions. The credits, the first credit they're going to talk about is related to the not the CARES Act, but it's the right before the FFCRA. These are this act expanded paid sick leave and mandated it for certain employers. Before it was a mandate under FMLA for employers with 50 or more workers, and they had to provide this coverage. But now they've expanded that. They've added, if you're paying someone to sick leave as a result of an illness related to COVID, to care for somebody who has COVID, to take care of a child that's out of school and you don't have child care or daycare. This act expanded that and required mandates employers with fewer than 500 employees to pay these sick leave wages. There is an exclusion for nonprofits with fewer than 50 employees who could apply for an exemption of these expanded benefits in that it would severely impact their business. So that may apply to your organization, that exemption from these paid sick leave wages. If it doesn't apply, what the IRS is what the IRS has given is a payroll tax credit, and it's a 100% refundable credit for these mandatory leave payments, and it's up to the applicable per diems and payment caps that are within the program. So under the paid sick leave mandate, the tax credits are $511 a day, and that's for self-care or care for another. And then if you're caring for a family member or a child whose school or daycare is closed, those credits, those wages are capped at $200 a day. And both of these types of wages are capped at 10 days in the aggregate. So, and the further cap is the $200 a day up to $10,000 each quarter for these wages. This is available to all nonprofits that are mandated to pay these wages, and the credit. I'll explain the other credits and then explain how the methodology to claim these credits. The next credit is the employer retention credit. I've been getting a lot of questions about the retention credit. The retention credit is a refundable payroll tax credit, and it's worth 50% of up to $10,000 of qualified wages for eligible employers. So $5,000 an employee. This credit to qualifying. You have to be an eligible employer, and then you have to have qualified wages. To be an eligible employer, you either have to have your operations fully or partially suspended as a result of a government order due to COVID, or you have to have a substantial decline in gross receipts. And that substantial decline of gross receipts is 50% or more of gross receipts in the calendar quarter of 2020 versus the calendar quarter of 2019. And there are a lot of nuances within this. So once you become an eligible employer, then you have to look at what wages qualify. So, and it breaks it down between large and small employers. A small employer with 100 or fewer employees, the wages that qualify under this credit are for wages paid regardless of whether the employee is working. For larger employers, more than 100, the qualifying wages are paid to those employees who are not providing services. So for small employers, you could have your business shut down and you could send them home and they could still be working, teleworking and doing that. And you could pay them, they're providing services, and you'd still get the credit for those wages that you're paying them to do something. For larger employers, you have to send them home and they have to not be working in order to count those wages as qualifying wages. There have been a lot of FAQs. The IRS released nearly 100 FAQs related to the retention credit, and a lot of time is being consumed with this. And the caveat here is to document and to get on it early, and time is of the essence to really look and understand whether or not you would qualify for this credit. It is available to all 501c organizations.
Mark, we did get a question in the Q&A about whether or not there's a difference if they don't have full-time employees but just part-time employees and applying for the retention credit or taking advantage of that. Any thoughts on part-time versus full-time? We could follow up too.
Yeah, it's There's not a distinction between full-time. Yeah, there's not a distinction between full-time and part-time. It's wages. Again, for small employers, the paid if they're working.
Mark, I don't know if it's your phone or my phone, but
Yeah, it's his.
I think it's Mark's, yeah.
Mark. Gonna have to text or Mark, we can't hear you. Sorry. Tyler, could you text Mark and maybe we can.
And it doesn't matter. It's whatever wage you pay. If you're that small employer with 100, if it's a larger employer and they're 20 hours a week regular working and you send them home.
Hey, Brad,
Our
I can jump in
apologies.
on the next question.
Yeah, why don't we, why don't you jump in on that question and then I'll try to
Sure.
get Mark.
Sure, I'll read the questions.
And you're still paying them and they're not working. Those wages.
So the question that came in.
Can you hear me? Hello?
No, Mark, your phone's not
Hello?
working.
Hello?
You're in and out, Mark.
Yeah, sorry.
So let me read this question. I am concerned to ask my board to accept my budget reductions just yet, as much as my funding will be reliant on the state budget and what grants will be available for next school year. I'm a nonprofit adult education center. I am more concerned about next fall than I am today. Okay. 2 questions. Does the panel have any insight into the state budget impact on nonprofit grants, and what is my best timing with the board? So the first question is, what we're seeing with states is they're trying to determine what is allowable and not. And what they're doing is they're trying their best they can to make as much fit under the initial allocation they got in the first round of funding. I was just working with another state yesterday looking at that and how they can get this through. So I don't think they've made, I would ask the agency that sends you the money if they've made that determination yet, because, you know, they're also worried about 3 years later getting an audit and getting it clawed back. So the best thing I would do is call your contact at the state agency that sends you the money, because some funding sources are clear and some are a little gray and they're working on it. When it comes to the timing of my board, I would be talking to my board as soon as possible. And what I would be saying is telling them what you know, and I would still give scenarios. Hey, if everything goes the way we're planned, here's our budget. You know, and that may be best case or that may be actual case. And then I would still do some scenario planning. Even if you don't give the scenarios to the whole board, I would at least have some board members, depending on how big you are, or somebody kind of be looking at that. If it's your finance committee or your audit committee, depending on how you function, and have them giving you some feedback on, okay, some what if scenarios. Because depending on what happens, you're probably going to get asked some of these questions. So I would be prepared and start doing some of those. Dave, I mean, anything you want to add to that?
Yeah, no, Jeff, I think that's good advice. And I think that particularly in the smaller not-for-profit organizations, the chair of the board or the finance committee chair or both might be good resources. But I agree that, you know, nobody has a crystal ball here, and everybody that's making projections is likely at some point to change them for whatever reason. And I think it's better to be upfront and honest about what you can and can't predict, and just stress in every scenario that there's probably a best case, worst case, and middle of the road. And, you know, I think board members really do understand that during this time, they're going to be leaned on a lot more than they normally are. So that's my take.
Hi, this is Mark Shelton. Can you hear me?
Yes.
Yeah.
I apologize for the technical difficulty.
So there was a question, Mark. I don't know if you heard the question or not. because I think you did and you were starting to answer, but you got gargled there on the full-time versus part-time.
Right. And I don't know where I cut off, but the answer is if you're paying someone, these are wages. Again, you have to be an eligible employer. So if you meet that, the gross receipts test or the partial or full suspension of operations, and you're paying someone to work or not work, if you're a small employer, or you're paying someone to not work as a large employer, there's no restriction on that. It can't be more than they would have been paid in the prior 30 days, I believe the requirement is. So you can't just give somebody a huge bonus now and pay them and get a retention credit for that. But there's no restrictions that I'm aware of.
Well, Mark, should we finish these other sort of things to keep in mind and then open it up for any final questions?
Yep, let's keep going on that. So the retention credit, the emergency sick leave credit, those are all credits that can be refundable, and the method to claim these credits, what organizations are allowed to do or permitted without failure to deposit penalties or to withhold these qualifying wages for the credit as they calculate it from their employment taxes deposits, and at the end of the calendar quarter, all these different credits, the retention credit, the sick leave credits, those are all reconciled on the Form 941. There's a draft out there. For the retention credit, this is if you've withheld more from your deposits in the calendar quarter than you had to do deposit, and you have more credit to claim, you can get an advance refund through the filing of Form 7200. So if you need cash flow immediately and you're able to take these credits, you can do that in advance of the 941 filing for those credits. There's another provision, it's the Payroll Tax Deferral. What this really is under the CARES Act 2302 is it's an interest-free loan. Essentially allows an employer to withhold the 6.2% of Social Security taxes from deposits for the entire 2020, and then pay them back over a period of a couple of years. 50% of the amounts withheld would be paid back at the end of 2021, and the remaining 50% would be paid back at the end of 2022. And I'll talk a little bit about SBA. It's not a tax provision, but these are liquidity facilities that nonprofits are eligible to receive, and there's some interaction between them and the credits. The SBA loans, the PPP, that low interest loan, the 2-year term up to $10 million, it's eligible. 501c3s and C19s are eligible to take it. It's for small employers, less than 500 employees. The cherry on top of this one is that it's forgivable. If you use it, it maintains certain staffing levels and use it for payroll costs and occupancy costs. This can be, the debt cancellation on this would not be considered UBI. The interaction between this and the credits, if you've taken an SBA a PPP loan, you're not able to take the retention credit. They came out with some new guidance recently. If you pay it back by May 14th, then you would be able to take the retention credit if you're in that situation. It interacts also if you receive forgiveness on the PPP, the payroll tax deferral, you can take it. You can take the payroll tax deferral, but at the point at which you have the PPP loan forgiven, that is, you're no longer able to defer payroll taxes. There are a couple of other SBA loans, the EIDL loans. Those again are favorable loans with low interest rates, up to $2 million, 2.75% interest, and payments and interest are deferred for up to 4 years. C3s can take this loan, and there's a grant portion, an emergency advance portion of this, which is forgiven up to $10,000, regardless of whether or not you get that EIDL loan or qualify for it. A lot of organizations have taken that. I'll mention also this economic stabilization fund. It's through the Main Street Lending program. It's a treasury loan. Technically, it is. I've had people ask about this. It is available to nonprofits, but effectively, it's not right now. There's not a metric available for nonprofit organizations to be measured by lenders. For profits, they use EBITDA, and nonprofits, they haven't quite figured out how to use that. So while it's technically available, it's not effectively available. So I just mentioned that because I've had people ask about it. A couple of other tax matters, and these are for nonprofits that have a UBIT, large UBTI amounts. The AMT was repealed a couple of years ago through TCJA, and those credits could be were limited and had to be claimed over the course of a few years. What the CARES Act did was allow organizations who have an AMT credit for that to be fully refundable in 2019. Another provision is NOLs. The CARES Act temporarily waives the 80% limitation to taxable income, so that an organization can fully use the NOL in the current year to offset income. What it also does is allows carrybacks were taken away. The use of NOL carrybacks were taken away, but CARES Act allows an organization to carry back losses in 2018, 19, and 20 to up to 5 years back. So those are a couple of provisions that organizations can use to accelerate those credits and those NOLs, and possibly play some rate arbitrage with the rate being quite 21% and then higher in the previous 5 years. So if you're able to capitalize on that, those are other ways to get cash in the door with quick refunds of those, or filing amended returns. The next slide and the last things that I'll talk about are just on the donor side of things. What the CARES Act does is provides a new above-the-line charitable contribution deduction for non-itemizers of $300, and for itemizers, it increases the charitable contribution deduction to up to 100% of AGI, so there's no limit. It was 60% before. Corporations, their deduction for contributions is increased from 10% to 25% of taxable income. Gifts of food inventory was also increased from 15 to 25%. That's not on there. And And the requirements of all these, minus the gift of food inventory, they've got to be in cash. They got to be made in 2020, and it's got to go to a public charity or operating foundation. So contributions to if you're a non-operating foundation, a supporting org, or a donor-advised fund, it would that would not qualify. That really summarizes the things that I've been talking about with clients related to CARES, how to get money into the door. I would say use anything that you've heard here as a talking point or discussion point to reach out with your tax advisor, legal advisor to see if any of these would apply to you to help you get money back in the door. And
Mark, can I jump in? Okay. Yep.
Yeah.
We did get a question about the PPP loan, and can an employee still receive a planned raise? I'll let you answer that, but I would, just on behalf of KPMG, I would say that if you are looking at the Paycheck Protection Program, that certainly is a legal matter, and we would encourage you to seek legal counsel as it relates to PPP loans. But Mark, any thoughts on the planned raise?
Yeah, I don't know. I can't certainly hold myself out as an expert on the various provisions. So I would agree with that comment to seek legal counsel on the PPP loan.
I can answer the next one here, Brett. I'm a disabled veteran. As such, are there any benefits I should be aware of pertaining to forming and running a nonprofit or even a for-profit business? Many states do have programs, especially when they're spending their own state or local government money, that does give some procurement favoritism, for lack of a better word, or encourages the use of vendors that are veterans. I would go to your state veterans agency, Veterans Affairs, and ask them, between them and some of your disadvantaged business rules, you should be able to apply, and they can tell you what they allow and what are the different programs for you. But most states have something like that.
Well, Rennie, I think that's all for us. We have just a few minutes. I don't know if you want to close out, or you can always contact us.
Yes, thanks, Brett. I wanted to thank Dave, Jeff, Julie, Mark, and Brett for organizing today and sharing your thoughts about these different subjects. There was a quick question, and let me just read that and then we'll close because it's about 2 o'clock. With the charitable giving incentives, where can I find good language to use for communication to donors to explain the incentives? Is there a best site to point donors to so they can understand the incentives? Does any KPMG person want to answer that, or I'm happy to do
Yeah, this is Dave, Rennie. I might suggest going to the American Council on Nonprofits. I couldn't tell you the website, but if you Google that, there probably is some guidance there.
Yeah. Great suggestion. It's actually the National Council of Nonprofits.
Sorry, the National Council of Nonprofits.
You had the right idea. You had the brand in mind, Dave, so that's good.
Yep.
So just Google National Council of Nonprofits. That is a wonderful organization that consists of state associations like the Colorado Nonprofit Association, and they do have lots and lots of good resources, and that's a great thought. Also, Colorado Nonprofit Association we don't have sample language, but we certainly have information about a lot of the topics that we have today.
That's right.
So I wanted to again thank the KPMG team. I also want to thank Marianne Ott and Justin Miller for Justin's company is providing WOWSA is providing these services to Energize Colorado. And just close by saying that Energize Colorado is really, it's a large group of volunteers who are really committed to help each other all across Colorado. And so this webinar is organized through that, and KPMG is offering their time, and a lot of people are offering time too. So go to the energize.com website in order to find other resources that are applicable to you, and look for other webinars that may be of interest, as well as other resources under the, there's a lot of different buttons on that site to get different kinds of help. I should say also in the closing 1 minute here that Energize Colorado did also launch a PPE purchase site that is at cost. So I know that nonprofits have to have personal protection for their staff, for their clients, and that's something all businesses are needing to do. And so take a look at that as an example. So thank you very much for your time. Again, thank you, Justin, for operating this, and we'll stay in touch.